This video is full of data, analysis, and predictions about the year ahead for housing. If you're thinking about buying or selling or investing in real estate this year, or you're just curious about the market, you came to the right place. I've done the work for you, pulling together all the relevant data you'll need to make informed decisions, and I'll share some predictions and teach you exactly what to watch as the year unfolds. Before I dive in, I want to give a brief introduction to myself, I guess. My name is Julie Felsman, and I've been a residential loan officer for 29 years. I love what I do. I'm based in Portland, Oregon, licensed in helping folks with mortgages in all 50 states. My team and I are available for conversations about mortgages all the time. This is what we do for a living, but this video is not about mortgages. Instead, I'm going to pan back to the big picture and talk about the market. I am a mortgage lender, not an economist, and I don't have a crystal ball, but to advise and serve our clients at the highest level, I've really become a student of the markets, and I've assembled and will share what I find to be the most relevant information. I hope you'll feel better informed after watching. You'll be able to draw some of your own conclusions. I'm going to put my sources in the description. But if you're thinking about buying or selling or investing in real estate in 2023, this information is for you. And honestly, even if you're on the sidelines and eating popcorn and not in the market, it is just a really interesting time in the market. It's kind of a fascinating time. So before I get rolling, please don't forget to like and subscribe for more content like this. And yeah, here we go. So, the information that we're going to talk through is really kind of divided into these 5 categories. I'm going to talk a little bit about 2022 in review. Before we look forward, 2022 was just an incredibly exceptional year, and we have to kind of look back to make sense of what we're going to see ahead. Of course, we want to talk about interest rates and the economy, what to watch in the year ahead, and I'm going to, throw down and talk about whether I think it's a good time to sell or to be a buyer, and then share a few key strategies for today's market, the things that I think there are a lot of strategies you can employ in any market, but a couple that I think are particularly relevant for the market that we're in. So a look back before we look forward. 2022 was honestly one of the most extreme years in housing ever, and this will become apparent as we talk through some stuff. Some fascinating things happened, and we're really going to set the stage for talking about what's coming in 2023. So what was 2022 all about? Again, as we roll over into 2023, we just can't help but talk about inflation. Inflation was a driving force behind everything in housing that happened in 2022. If my life as a mortgage broker was a comic book, inflation is the supervillain. And to understand why this is, we really have to talk briefly about where mortgages come from. Everything really starts when a home buyer, maybe you, gets an offer accepted on a property. At closing, we lenders send our money to the closing table, and what we get back in exchange is a piece of paper, a promissory note, your promise to pay the money back with interest. And this is called the primary transaction. But no lender has a bottomless well of money from which they can lend. And we need a method by which to get our money back so that we can stay in business and continue lending. And to replenish our funds, and kind of avoid lenders running out of money. Back in what I guess I'll call the OG housing crisis, the Great Depression, the government, Congress chartered Fannie Mae. It was 1938 when Congress created a secondary market for mortgages. Lenders can bundle up their promissory notes and sell them to Fannie Mae and get their money back to lend again and again and again. But of course, Fannie Mae has to get its money someplace. And where Fannie Mae gets its money is by securitizing mortgages. They take all of the mortgages they buy from lenders, they bundle them up, and they sell bonds to investors. These bonds are called mortgage-backed securities. And when an investor buys a mortgage-backed security, these mortgage bonds, they're handing over their money in exchange for the stream of payments, the interest and principal that a group of people are paying on their mortgages. So your mortgage, if you're borrowing, is someone's investment. And to understand how inflation plays into things, it's kind of natural for those of us in the housing industry. If you're a home buyer, you're a real estate broker, I'm a mortgage lender, we really kind of focus on the borrowing side of things, right? So I'm going to turn the tables for a minute and say, okay, think like the lender, think like the person buying the bond, the person who's actually lending the money. Imagine that. Every month after you've made this investment and handed over your money for a mortgage bond, you're collecting a monthly payment. And every month you're going to take that payment that you get in, and you're going to go out and buy a basket of goods and services with it. But over time, as inflation makes costs rise, you can't buy the same stuff, as much stuff. That basket of goods and services, you're not going to be able to stretch all the way and buy everything. And that's really the effect of inflation eroding the value of money over time. Now, when inflation is really low, as a lender, we can charge a really low interest rate and we're not going to see a whole lot of erosion. But when inflation has gotten higher, then as an investor, we're going to demand a higher rate of return, right? That's going to kind of insulate us from the effect of future inflation. And with the high rates of inflation in 2022, of course, this next slide we're going to look at makes really perfect sense. So let's look back. What were interest rates in 2022? So we started the year out with interest rates in the low threes, 3.22. This data, by the way, comes from Freddie Mac. And again, my sources will be in the description if you want to go play around with this yourself. And rates started climbing and they really didn't let up. We hit the fives by May and we pushed pretty close to 6 in June. And that was when the market really shifted. The market was actually hanging in there pretty gamely as you'll see on some future slides until that point. Rates kept pushing higher, and in October we crested over 7% for interest rates, the highest rates we've seen in 20 years, and this was because of inflation. But when inflation started ebbing back, we started to see interest rates pull back a little bit. And I'm recording this a couple of days after the December Consumer Price Index was released, and it showed continued decline. Inflation is still too high, but it's getting closer to where we want it to be, and that's good news for interest rates. Now, I want to put this into a little more long-term perspective. So we're going to look at interest rates going back to 1971 now. And if you look at, the big picture, well, 2022 wasn't fun. You can see this spike up in interest rates, of course. And we're really not that far out of line with a lot of the 2000s, right? The average rate over this full period of time is 7.75%. We never got that high. So what's the fuss all about, right? It wasn't that interest rates, it wasn't the level of interest rates that created the excitement that we had, kind of the chaos in the market in 2022. It was the pace at which interest rates went up. And this chart shows the year-over-year change as a percent. And you can see even back in the 1980s when interest rates were 18.5%, the year-over-year change between as rates went up, it didn't go up as much as we've experienced just in the last year. And that's partially because we started at all-time lows during COVID and then climbed to 20-year highs very, very rapidly. At one point, we were actually up 138% year over year. So it was truly the pace at which interest rates changed that was completely unprecedented. So obviously, this is going to have an impact on home values. Now, I'm going to use some data here for my home market, which is the Portland, Vancouver, Hillsborough metropolitan statistical area, and in a couple of places where I'm not using national data, when it seems more interesting to use something local, that's the local data I'll use. If you're in a different market and you want to see this data for your market, I would be happy, put a comment. I can put a link to some of the sources, but, a real market, all real estate is local, right? So let's look at a real market. This data comes from Redfin, and this dramatic impact on The dramatic change in interest rates definitely impacted the market. So this line that you're looking at right here, this is 2019. It was kind of our last normal year in real estate. And in the Portland MSA, we started the year at $382,000 median home price, and Freddie Mac's data tells us interest rates were 4.5% as we rolled into 2019. By the end of 2019, the Portland MSA was a $404,000 median price, and interest rates had fallen just a little bit to 3.74%. We had 4% appreciation over the year. A long-term average of appreciation for the Portland metro area is about 5.6%, so we were a little lower than a normal year of appreciation. Then 2020 came along, and of course, we all know what happened in 2020. We started the year before all the excitement started with COVID at a $400,000 median price with 3.72 for the interest rate. And we ended the year at $448,000 for the median price, which was 11% appreciation, twice our typical rate of appreciation, because look what happened to interest rates. They fell to 2.67. And as we rolled into 2021 with interest rates in the mid twos for 30-year fixed rate mortgages, we started the year with a $450,000 median price and ended the year with a $514,000 median price, 15% appreciation. Interest rates still in the low threes, 3.11%. Now, 2022 was an interesting year. Interest rates did start rising. We started the year at 3.22, and as rates hit 4, we still saw prices rise. So when I said the market was hanging in there, like there was still a very active market with home buyers out there chasing a limited inventory of homes for sale, and prices rose 16% year over year. In June, that inflection point that I mentioned, rates hit 5.78%, pushing up towards 6. That was the crest of prices in the Portland MSA, pretty close nationally in most markets at $577,000. That was a 12% rate of appreciation year over year. Now, interest rates continued to rise, and we hit the high point for interest rates in October, just over 7. Prices had begun to fall, but we still had 7% year over year appreciation. And then we ended the year at $516,000, basically the same price at which we started the year. Interest rates had fallen back to the mid sixes, but we ended the year basically flat on values, just about at a 0% rate of appreciation. Now, I don't know about you, but if you had told me in January of 2022 that we were going to see interest rates climb by 4%, I would have guessed that home prices would have done worse than this. I would have guessed that they would have fallen, but they didn't. We ended the year with a flat rate of appreciation, and the reason for this is inventory. We, from the peak levels, 4 million homes for sale in the United States, these are national numbers in 2008 at the height of the housing crisis, the number of homes for sale has fallen. And you'll see there's a seasonal cyclical ebb and fall, but the trend has been down and down and down. For the inventory of homes for sale. And we hit all-time record lows of homes for sale during COVID. They rose seasonally this fall and winter, but they're already starting to fall again. And we could start the new year with less than 1 million homes for sale nationally. That's about half of what we typically see. A normal market has about 2 million homes for sale, and we're pretty close to 1 million at this point. The reason for that, because higher rates have had a cooling effect on the market, right? Demand has been affected by these higher interest rates, but the real issue has been homes have not been coming on the market. Newly listed homes on a national basis, and this is Realtor.com data, over a 12-month period, they're down 21% year over year from last December. In the market I'm in, Portland, they're actually down almost twice as much, 40%. New listings have fallen off so dramatically. The reason has really got to be interest rates. Many would-be sellers are just losing their interest in selling a property. It's pretty unappealing and maybe unaffordable to sell a property. If you've got a 3-point something interest rate locked in, maybe 2-point something that you refinance to during those low rates in the last couple of years, it's pretty hard to give that up, maybe even unaffordable to give that up to go purchase another property. So a lot of potential sellers just aren't selling. So our market went through a lot in 2022, and it's been pretty disrupted. Given all the excitement, I will say I'm a little grateful for the gray hairs on my head. Having some context definitely helped me really have confidence that no matter how weird things feel in the moment, and they definitely felt pretty weird in the moment at a lot of times, they'll eventually revert to mean things will settle back down. It was interest rates that caused all of this excitement. So, if we're looking for what is going to cause things to settle back down and the market to normalize, it is really interest rates that we want to watch. And interest rates are going to fall again when inflation abates. Inflation is going to abate when we probably have a recession. Now, I know the R word is kind of a scary thing. I think, a lot of us still have a little PTSD over the housing crisis. That was, by the way, our second to last recession, not our most recent one. Our most recent recession was during COVID. We had a recession right as COVID kicked in. That one was very brief, very deep, didn't last long, and we were all incredibly distracted. But the recession before that was very long and very drawn out recovery. And, the good news is we are probably in for another shorter, milder recession in 2023. And there are really a lot of reasons to expect this recession to be a mild one. For one, during COVID, businesses and consumers built up absolute record levels of savings, trillions of dollars of rainy day fund that they can draw down on as we hit a rainy day, a recession. Critically for home values, there are basically no distressed sales right now. Home prices fell, and the recession of the housing crisis was so deep because we had kind of cascading foreclosures. If you look at even the wind up to the housing crisis, on this chart, the blue line is foreclosures and the red line is bankruptcies. This big spike, by the way, corresponded to a change in the bankruptcy laws. It was going to get more difficult to file bankruptcies, so lots of folks filed bankruptcies kind of in a big hurry before that law changed while it was easier. But if you look at that blue line, it was climbing well before the housing crisis got rolling in 2008 and 2009, and obviously kind of hit a crescendo and has fallen off. And we had this moratorium on foreclosures during COVID, so you see kind of a period of no foreclosures whatsoever. And you'll see a lot of headlines right now saying foreclosures are up 200% or whatever, but they're up 200% from almost nothing to all-time lows. We just do not have any foreclosures happening. And that kind of makes sense because in the mortgage industry, we are underwriting really good loans. The majority, the average credit score for someone getting a new mortgage right now is 720. And don't be depressed if your credit score isn't 720, by the way. We're making, there are mortgages to be had for folks who have lower credit scores, even credit scores below 620. But, if you look at the distribution of credit scores, the proportion of folks with higher credit scores receiving loans, back as we wound up to the housing crisis, and now it's, a very obvious difference. And on top of that, homeowners have just an huge amount of home equity currently. As we wound up to the housing bubble, we had a little bit of equity and actually, saw that equity position flip, but holy cow, do we have a lot of home equity right now. Record levels, in fact. And mortgage debt service is very near all-time lows. The percent of disposable income that U.S. consumers are spending on their mortgage payments is just under 4% at the moment, and that is very near all-time lows. 85% of mortgages nationally are locked in below 5%. In my home base, Oregon, it's 90.8% of mortgages are locked in below 4%, or 5% rather. Folks locked in those great rates when interest rates were low during COVID, have a ton of equity and affordable mortgage payments. So it's a good reserve to kind of see us through any recession that's coming our way. And honestly, we just can't have the economy that we want with runaway inflation. Price stability is too important to a healthy economy. So I don't want to say we want a recession, but we need a reset button when it comes to inflation. And a recession is, likely going to be that reset button to get inflation back under control and get us to that healthy, stable economy that we want going forward. So speaking of going forward, let's look forward and talk about things to watch in 2023. And I really have 3 things that I'm going to keep an eye on closely and suggest you do too. And I think that'll inform where a 4th thing goes. We want to watch affordability. We want to watch interest rates, of course. We want to watch the inventory of homes for sale. And where these 3 things lead, I'm reasonably confident that's where home prices are going to go as well. So I want to talk about each one of these things in turn and share a little bit about what I see coming for each. So first I want to talk about affordability, and I can't emphasize enough how this is the biggest challenge that we have in the market right now. Affordability has really been crushed as interest rates and home prices have both risen. It's been a heck of a challenge for home buyers. Affordability, if we want to talk about, okay, what is affordability? In essence, it's how many people can afford to buy a house. So as we saw prices go up, as we saw interest rates then take off in 2022, as rates fell, more buyers could borrow, and that was part of what drove rates up. And then as rates rose, fewer buyers could afford to buy, and they fell out of the marketplace as affordability eroded the ability for folks to buy things. And the demand for housing, fell with affordability. Now, often we talk about affordability in terms of an affordability index. The National Association of Realtors, NAR, puts out this affordability index on a monthly basis, and it's worth looking at, but it's a little esoteric, and so I thought it might be a little more real world and interesting to imagine a family, the medians, and we're going to follow them through a potential home buying journey in 2022. The medians are purchasing a median priced home. And again, I'm going to use my home base, the Portland metropolitan statistical area. We looked at these numbers from Redfin previously. So in January of 2022, median home price a year ago, as I'm recording this, was $512,000. And a borrower who our median family puts 20% down. By the way, the down payment is, I don't want to say irrelevant, but the idea behind this, the down payment doesn't really play into it. The down payment amount is still going to be tied to what that median price is, and the monthly payment that we would have, $1,776 if you put 20% down on a $512,000 purchase price at our interest rates at the beginning of January 2022. We land at $1,776. So as rates started to rise and prices continued to rise, that monthly payment increased. And the market held in there okay. I mean, the monthly payment was on a median home, $381 more as prices hit $554 and the interest rates went a little over $4, $2,157. And my theory about this, just talking to a lot of home buyers every day, is that $381 a month is not money you want to be spending on a bigger mortgage payment, but it's kind of like having that car that you just paid off, not paid off anymore, or paying a little extra on your student loan or something. There's room in a lot of folks' budgets to find something in that neighborhood. It was really when prices started to hit close to record levels in June and interest rates climbed up towards 6% that we started to have a real problem with affordability. A median priced home at 5.78, the payment hit $2,700. That is $900 more on a monthly basis. And even as prices started to pull back again in October, when interest rates really crested up at their highest levels at 7, we were up about $1,100 in mortgage payment on a median priced home in the Portland market. As prices have started to fall back and interest rates have improved, that's gotten a little bit better, but we started the year with about $800 more monthly payment on a median priced home January to January. A little bit better, but still ouch, right? Like that is a lot of money, and that is why we're seeing less demand in the housing market and some of the disruptions. So this combination of higher prices and higher interest rates, they are two of the three elements that make up affordability. There is another element to the affordability equation, and that is incomes. So the median family income for a family of four per the Census Bureau at the beginning of January 2022 was $8,075 in the Portland marketplace. At the end of the year, as we rolled into January 2023, that income was up 9% to $8,875 on a monthly basis. So the difference from January to January was $800, which came very close to actually closing that affordability gap at the end of the year, with some huge caveats. Inflation, well, first of all, medians are not real people, right? We're talking about statistics, not humans. So that's an important distinction. But inflation has increased the cost of other household goods and services and expenses, right? So this hasn't fixed our affordability problem, but higher wages are clawing back some affordability, and that is totally welcome news. And before we change topics, I actually want to kind of look forward and be a little bit of an optimist for a second, because home wages are still rising. And let's imagine we get lucky. Let's say that our medians went ahead and purchased a home January of 2023, and they've got a $2,577 monthly payment, principal and interest. This is, again, not including taxes and insurance, since interest rates don't affect those things. Let's say they could refinance in January of 2024 to 5%. That would reduce their $2,577 mortgage payment by $352. Now we're still up from where we would have been January of 2022, but we're at $449 above that January payment rather than $802. And now let's imagine that incomes go up. And right now they're tracking to go up by at least 5% this year. Let's imagine we get that 5% increase, not the 9% we got, but just 5%. That would take the monthly income to $93.19, an extra $444 over the prior year, and $1,244 over where we were in January of 2022, which is $795 to the good. There's $795 that can go toward mitigating the expense that has been created by inflation and other parts of the median's monthly budget. Now, I can't emphasize enough that I don't have a crystal ball and I don't know what interest rates are going to be. And this is really just illustrative to kind of give you an idea of what could happen, what it might look like if interest rates start to come down and a refinance is possible. But please know that this isn't a promise of anything. And if you were the medians and purchasing a home in January of 2023, please budget for your actual mortgage payment for the long term, because we can't know what interest rates are going to be and if and when you'll have an opportunity to refinance and lower your monthly payment. So I hope that's self-evident, but I wanted to make sure I put that out there. So what do I see for affordability coming? I promised some predictions, and I do think we're going to see improved affordability through the year, with one perhaps paradoxical worry, and that is if interest rates begin to fall too quickly, that could stoke demand in the marketplace again and actually start to tip affordability back in the wrong direction. If we have a lot of interest in the market and that puts upward, more buyers coming into the market, that can put some upward pressure on prices that would perhaps negatively affect affordability, kind of send it back in the wrong direction. So let's shift gears again and talk about the next thing that I want to focus on this year, which is interest rates. Obviously, they were the driver of everything that happened last year with the housing market. And so we want to watch where interest rates go as the year unfolds. And we can't talk about interest rates without talking about the Federal Reserve. So the Federal Reserve manages U.S. monetary policy, and they have what is called a dual mandate. Their job is to keep inflation low and stable and keep folks working, keep maximum employment. And their everyday toolkit for making those two things happen, managing their dual mandate, are two interest rates, the federal funds rate and the discount rate. The federal funds rate is the rate at which banks can borrow money from each other. Every bank has to have a certain amount on deposit with the Federal Reserve based on what their obligations are. And if they're a little short, they can borrow money from a bank overnight that has a little extra. And the rate at which they borrow money from each other is the federal funds rate. The discount rate is the rate at which a financial institution can borrow from the government. And it's never a good thing if you hear an institution has had to borrow at the discount window. It means they were having a liquidity crisis and they might have been at the verge of failing. So right now the Fed, as I record this, has the federal funds and discount rate target set at 4.25 to 4.5%. As an important aside, which is sort of part of how we got where we are with inflation, the Fed used another more exotic part of their toolkit, something called quantitative easing. They sort of created this tool during the housing crisis and then deployed it very liberally during COVID, maybe too liberally in hindsight, and stoked some inflation that was not helped by the terrible war in Ukraine. That's a story for another day, but that's really how we got here. So back to this kind of everyday toolkit of managing the economy with interest rates. Well, how do they do that? As they lower interest rates like they did during COVID, for example, the Fed is really pressing the gas pedal on the economy. They're trying to stimulate growth. If it's really cheap to borrow money, then like many people did, you're going to borrow money and go spend and buy things and get more money circulating in the economy. It doesn't pay to hold cash in savings when interest rates are very low and you're not getting much of a return. And so you're going to go invest and spend and maybe put money into riskier investments like stocks and see the stock market go up. And all of that helps grow the economy. Now, the Fed has aggressively through 2022 and rolling into 2023 been raising interest rates. And that's really like tapping the brake on the economy, or right now kind of jamming the brake down on the economy. It makes it more costly as you raise interest rates for consumers and businesses to borrow money. It also makes it more appealing to save, right? You're not going to spend and put money out into the economy if you can get basically no risk investments like treasury bills at 4% interest rates right now. Why put your money into a riskier investment like the stock market if you can hold it and save it and put it into something safe and secure and get a pretty good rate of return. So it really has a slowing effect on the economy. Now, today's Federal Reserve has kind of thrown its dual mandate kicked it to the curb. And I would say we have a single mandate Fed right now. They have jammed the brakes on raising interest rates. They're pretty vocally not concerned about what happens with employment right now. They're actually looking for wages to come down and even projecting slightly higher rates of unemployment. We're very, very low right now. So, still low, but slightly higher rates of unemployment to get the inflation horse back in the barn. I would say kind of an interesting, as you're watching this year, an interesting inflection point to look for is to look for a moment when the federal funds rate is higher than the rate of inflation. That is a moment when the Fed has probably gotten the inflation genie back into the bottle. Now, mortgage rates, since we're talking about the housing market and mortgage rates will probably be coming down before that point. The mortgage marketplace tends to anticipate these things and start moving in advance. I guess as another aside, I'll say if 2022, if you're, kind of a participant in the housing market in some way, buyer, seller, real estate community, if you felt like the Fed had it in for you this year, you know how they say, just because you're paranoid doesn't mean you're wrong. This was not your imagination. Housing is an extremely interest rate sensitive industry, and it's actually a pretty good slice of the economy, 15 to 20% of the economy. So the housing market is a pretty efficient way for the Federal Reserve to transmit their policy to try and, if they're trying to slow the economy, the housing market's a good place to slow it. And Jerome Powell, the Federal Reserve chair, came out and said it. He's trying to get housing back into balance between supply and demand by raising interest rates and crushing demand. So that is, a feature, not a bug. It is not an accident that the Fed has affected housing. Now, this is a little bit of a maybe slightly depressing but important editorial aside that I want to mention, which is short term, you can absolutely crush demand by raising interest rates, right? And that will rebalance the market. If people can't afford to buy houses because interest rates are really high, then people won't buy houses. They can't. But long term, demand is people, and people need housing. So, and this is particularly acute because we have our millennial generation, the biggest generation of Americans ever, right in the middle of their prime home buying years. And only more housing is going to long-term fix housing affordability. So at the moment, we have higher interest rates crushing demand, and our new supply, builders build our new supply. Builders are not excited that they don't have a good market for the homes they're building, and so they're pulling back on permitting new construction. And kind of counterintuitively, we may be making our long-term imbalance between the supply and demand of housing worse while interest rates are higher and builders are building less inventory to meet that demand that's out there. We can crush demand, but what we ultimately need is supply. And I don't have an answer for that. But if you're thinking about, whether you want to purchase real estate or not, it is just a dynamic to keep in mind. Now, I'm going to get a little bit geeky and wonky for just a minute here and talk about something that's a little bit inside baseball, but it's a really fun thing to watch this year. And if you hang in there with the geeky wonky stuff, the mortgage geek moment here, there is actually kind of an interesting silver lining at the end. So I'll talk through this, and if it's a little dull, I apologize. But in addition to mortgage bonds, we talked about the mortgage-backed securities market and where mortgages come from. In addition to mortgage bonds, there are lots of other bonds issued in the world. If, for example, Apple wants to borrow money, they can issue a corporate bond. And when the U.S. government wants to borrow money, it issues treasury bills or treasury notes. The mortgage rates very, very closely track the 10-year T-bill. This chart that you're looking at is the 10-year T-bill, the blue lower line, and the upper yellow line is the 30-year fixed rate per Freddie Mac. And you can see they track along with one another absolutely beautifully. The mortgage rates are higher, and the reason they're higher is that mortgages are a riskier investment. So we have to go back to thinking about the investors again like we did before. T-bills have zero risk of default, essentially. It's pretty easy to make good on your debts if you're the government and you can actually print money. So it's pretty unlikely the government will default on that treasury note that you've purchased as an investment, a debt to the government, or the government's debt to you rather. And then when you purchase a 10-year T-bill, and this is really an important element, you know 100% for sure that the government is going to pay you interest for 10 years. Both of these elements are a little different for mortgages. Mortgages, although mortgage default rates are very, very low, there is always a chance that someone might not pay their mortgage. And so some mortgages will default sometimes. And then right now, really critically, a mortgage, a consumer with a mortgage can prepay that mortgage anytime they want. They can sell their house, they can refinance their mortgage, they can, get lucky, inherit money, win the lottery, whatever, and pay that off. When you're an investor purchasing a bond, if it pays off too quickly, if you buy it and you put good money into it and you get your money back without the interest you were counting on, you may wind up losing money. And as a result, this greater risk of prepayment and potential for default creates a gap between the 10-year T-bill and the 30-year fixed rate. And that gap is historically pretty consistent. It's pretty much always between 1.5 and 2.5%. But here in the second half of 2022 and right now, that gap grew, and it's been between 2.5 and even upwards of 3%. This AP headline that I found kind of calls this out and says economists are baffled by a wider than usual divergence between the long-term bonds, the 10-year T-bill and the 30-year fixed rates. The gap's a little hard to see on that other chart, so I put this chart together, and it shows the difference between the 10-year T-bill and the 30-year bond over going back to the 1990s. And you can see back in the early to late 90s, the gap was a little bit closer to 1 to 1.5%. People used to pay more for their mortgages and something called discount points back then. So that made up for some of this difference. But anytime from about 1999 onward, we've largely lived in this 1.5 to 2% range, other than 3 notable and strange moments economically. One of which was the beginning of the housing crisis, another one of which was the beginning of COVID, and the third was now. Interest rates have started to pull back, or the gap has started to close a little, but we're still well above normal. And that AP headline said that economists were baffled, and I've got a thesis that explains the gap, and I don't think they have to be so baffled, and that is that, and this is where the silver lining comes in, it's a gap. This gap is a signal that the smart money thinks interest rates are going to be coming down, that interest rates are going to fall, and that today's mortgages, anybody taking a mortgage out today in the 6s, for example, or 7s in October, they're going to be refinancing and they're going to be paying the loan off early. And that likely, high probability of early payment diminishes the attractiveness of mortgage bonds to investors and creates a reduction in something called loan servicing values. It's a little bit of another side topic, but when the mortgage note is created at closing, Fannie Mae is going to securitize it, but they don't want to collect the monthly payments. So they have a contract with someone. The mortgage lender you'll actually see on your mortgage statement is a servicer collecting the payments, and those servicing rights should have value. You get a little fee over time for being a servicer. But again, if a loan's going to refinance out of your servicing portfolio, then you're not going to get very much. And so this high divergence is a good sign, and it has the opportunity to create a positive feedback loop as interest rates start falling. And if the gap was more typical, if we were at kind of a more typical 2% gap right now, interest rates would really be 1% lower today. And so if that gap starts to normalize as interest rates start to fall, and the risk that new mortgages being originated will have less probability of refinancing or paying off, prepaying in the short term, then interest rates may actually kind of cascade down a little bit quicker than expected as that gap closes. So there's a little silver lining there. And a fun aside for anybody who is in the market, if I'm right and we start to see interest rates fall, every time interest rates decrease by 1%, buyers will see a 10% increase in their buying power. That's at any given monthly payment you choose, you'll be able to buy about 10% more house at a 1% lower interest rate. So where do I see interest rates going? Well, I think they're headed in the right direction. We should see interest rates come down in the year ahead. The Fed, however, is going to be sticking to their talking points, and their talking points are inflation is too high, rates need to go higher. When they get rates as high as they can go, they're going to hold them there. They don't mind doing a little economic damage along the way if it means controlling inflation. They talked about pain a lot in the fall. They'd rather do damage and beat inflation than repeat the mistakes of the 80s when they increased interest rates, thought they had inflation under control, started bringing them down. Inflation didn't keep falling and they had to raise again. That was kind of the twin peaks you saw in interest rates in the early 80s. They don't want to repeat those mistakes. So every time a piece of good economic news comes out this year, and I do think we're going to see a good bit of good economic news, interest rates are going to start to fall, the bond market will rally, and then the Fed's going to be like that person who always cuts in and then talks louder and faster and longer every time you try to cut back in and finish what you were saying. Inflation is too high, rates need to go higher. Once rates are high, we're going to keep them as high as they can go. The bond market is probably already calling the Fed's bluff a little bit as inflation data is looking better, but I would expect future improvements, but volatility along the way. Every time we get a good piece of economic data, then interest rates will get a little better, and then the Fed will talk tough and try to talk the market back down again. Occasionally we get a piece of data that doesn't look as good because nothing moves in a straight line, and the market will get a little worse, and then better data, and so on and so forth. It's going to be, I think, a volatile year for rates. But if I'm going to predict where interest rates are going to go, I'm going to say we're going to be in the 5s. If we see that gap between the 10-year and 30-year close a little bit, we could even get into the 4s, but I don't want to go that far out on a limb. So interest rates in the 5s for the year is what I'm going to predict. Now I want to shift to talking about the third element that I think is important to watch this year, which is inventory. And earlier we were talking about inventory in terms of the raw number of homes for sale in the marketplace. And I want to talk about inventory in a different way. And this is an interesting way because it really measures not just the number of homes for sale, but also the speed at which they're selling. And it is measuring inventory in months. So if we divide active listings by the number of closed sales, what we get is the number of months that it would take all of the homes on the market to sell out if no new listings hit the market. And I'm going to show data from the Portland, Oregon metropolitan statistical area because it is the data to which I have access. It's kind of easy access. It's my home base. It's pretty consistent with national numbers, actually. And this is the number of months of inventory of homes for sale in the market going back to 1999. So you can very easily pick out the peak of the housing crisis, right? January of 2009, we had 19.2 months of inventory of homes for sale, more than a year and a half of homes available for sale in the market. And obviously that fell tremendously, and corresponding very neatly to those high rates of home appreciation, we had record low levels of inventory over the course of 2021 and the first part of 2022. Inventories have risen. When I first put these slides together, I only had the November numbers at 2.6 months of inventory, and I was going to predict that we would see inventory continue to rise. And then right as I finished putting these together, the December numbers came out and we're at 2.3, which just happens to correspond exactly to the average number of months of inventory really since we've wound up the housing crisis and kind of been back in a normal or recovering housing mode. So we are right at a normal level of inventory right now. If inventory falls from here, we're falling back to lower than normal levels. If you want to watch where home prices are going, inventory is a really, really key element to watch. And this chart, I think, will underscore that to an extent. This is the inventory plotted against a month-over-month rate of appreciation. And there is an obvious pattern here. Prices decline when the number of months of inventory are high. Prices rise when the number of months of inventory is low. And there's a really obvious cluster between 3 and 6 months of inventory and about 0.25 and 0.75 per month rate of appreciation. That annualizes to about 3 to 9%. And the market I'm in averages about 5.6% over decades. So, we kind of live right in the middle of that. Now, I cheated a little bit when I brought this slide up because I wanted to demonstrate, again, how outside the box 2022 was. You'll see this big empty square right here. With inventory below 6 months, home prices have never been left of this meridian falling until this year. So I'm going to add a few months here. June of 2022, we started to break away from the herd just a little bit. We kind of lost that cluster. And remember, that's when interest rates started to get close to 6%. Now here's July, August, September, and October. We've put some dots in this square that was previously empty. So these are the first months we've had nationally with inventories below 6 months where home prices have fallen. I expect we're going to revert to the mean. Inventory is probably going to remain pretty low, and that should put a return to upward pressure on housing prices eventually. I do want to stop kind of briefly because I mentioned we're headed into a little bit, I think we're headed into a little bit of a recession, and just talk about what that means for housing prices. I think because the housing crisis led to such a big drop in housing prices, I think everybody has recession and home prices falling kind of tied together in their heads. But in the last 6 recessions, the housing crisis is the only time we've seen really significant prices fall. The twin recessions of the early 80s, the S&L crisis, the dot-com bust, COVID, home prices all kind of hung in there or went up. It was only the recession that was caused by housing when housing prices really fell back. Now, what do I see for inventory and prices? Inventory, I do think inventories are going to rise. Again, the most recent data has me kind of questioning my prediction, but I do think that inventories are going to rise, but not to those massive levels that we saw in 2009. And if rates come down, I hope we'll see a little more demand as affordability improves, and hopefully a little more supply as more sellers decide that they can afford to buy and then list their homes for sale. When it comes to home prices, I'm going to play Nate Silver for a minute here and average the experts. So what I've done here is aggregate from the most outlandishly pessimistic to a few folks I think might have a little bias, rose-colored glasses to the good side. And John Burns is predicting prices will fall twice as quickly as they did during the mortgage crisis in less than half the time, which seems incredibly unlikely, incredibly improbable to me. I do have high regard for Ivy Zellman. She's probably the pessimist I have the most personal regard for. She's calling for a 4% decline in prices. On the optimist side, Realtor.com probably has a little bit of an industry bias. Their business model is linking up potential buyers and sellers with real estate brokers. And CoreLogic and MBS Highway both sell services to mortgage lenders, a little industry bias likely there too, as well as the National Association of Realtors and Zillow and so on. So I think it's not a bad strategy to average, and I'm going to call for prices falling slightly low single digits over the course of the coming year. Now, what does this mean? All of this stuff we've been talking about, if you're thinking about stepping into the market as a buyer, what does this mean for you? Is this a good time to buy? Well, I'm going to steal a concept here for a second from, borrow concept from a blogger and financial writer, Sam Dogan. He uses the analogy of being long, neutral, or short on a stock with housing. And I think it's a really good way to get your head around. If you're trying to decide, should I buy, when is it the right time? I think this is a really good analogy to use. If this isn't in your wheelhouse, bear with me. We'll move on in a second. But when you're renting, you're really short housing, right? You're at the mercy of rising rent, inflation, job growth, household income, household formations rather, really pretty steadily, consistently over a long time horizon push rents up. You have zero opportunity for appreciation, but you would benefit if prices fell. If you're renting and you buy at a later date, you don't own now, then you come out ahead if prices fall. Now, when you go to purchase your primary residence, you own your home, you're now neutral housing. You're rising and falling with the market as far as home values go. You're no longer affected by rising rents. A 30-year fixed rate mortgage is a fantastic inflation hedge. You build equity, but you can't easily monetize it. You live in the property, so you can't up and sell it without disrupting your life. Now, you can monetize your equity by borrowing against it, but that means creating debt, and debt at whatever the prevailing interest rate is, whether it's favorable or not. And you're also probably not generating cash flows. You could Airbnb your basement or something, but you're probably not really generating a lot of cash flow from your home. If you own investment real estate, if you own rentals, now you're long real estate. You can benefit from rising rents, and you can sell for a profit whenever you wish. So there are times in your life when it absolutely makes sense to rent and be short real estate. It's super flexible if you don't know where you're going to be and you're at a stage in your life when you might be moving, or you're early in your career and you want to be nimble so that you can take a job opportunity someplace without having to worry about a home that you've purchased. Then renting is a great idea. But once you're settled someplace for 5 years or more, you really should go neutral. And this is where the S&P 500 stock analogy comes in really well. You might short the stock market, the S&P 500, for a short period of time. In 2022, maybe there was periods of time where it would have been a good idea to short the stock market. But over a 5 or 10 year time horizon, it would be a terrible bet to short the S&P 500. Don't do the same with real estate. Now, no market is all good or bad. So I want to talk a little bit about cons and pros that I see for being a buyer right now. The obvious con is interest rates. They have made it much less affordable to purchase a home as interest rates are up. Not everybody can afford to buy a home at current rates. Inventory is still low, so there aren't as many homes available for you to look at, and that low inventory is probably going to keep prices from really tumbling, and there's a lot of uncertainty out there. We don't know exactly where the market's going to be going, exactly where the economy is going to be going, and that uncertainty is something you'll have to wrestle with for yourself. On the pros side, there is much less competition and limited bidding wars, and I don't want to say there are none. I had 2 clients in multiple offer situations, bidding wars over the last week or so. So they're still out there, but they're much more limited. They're not to be expected on every single home like they were in 2021. And that means that if you don't have an enormous down payment, you are in the hunt as a home buyer. In 2021, if you wrote an offer with 3% down or 3.5% down, or you're a veteran buying with 0 down, sellers had multiple offers on their property. They had to filter through all the offers and say yes to one and no to all the others, and low down payment loans were a very quick path to the no pile. That is not the case right now. You're in the hunt with a lower down payment. And you have time to think and do due diligence and do home inspections and maybe look at a few houses before you decide to make an offer. Go back and forth and see a house more than once before you decide to make an offer on it. That time and the pace, the cadence at which the market is moving is much more buyer friendly. And then sellers are willing to make concessions. If a seller's house has been on the market for weeks or months with no offers, they're going to work with you to try to make buying that home feasible and more affordable. On the pro side, I would say, as a footnote, with no crystal ball to know exactly where rates are going, there are reasons to believe that you're going to have an opportunity to refinance if you purchase now and you're paying a little higher interest rate than you might otherwise like. And I would also say the uncertainty is potentially an opportunity. It's disrupted markets. Disrupted markets create opportunities. Timing markets, doggone hard. Unless you're Warren Buffett, if you time a market perfectly, you probably just got lucky. So I highly recommend and advise that you base the timing of your home purchase on the things over which you have more knowledge and more control. Not everybody can buy right now because interest rates are up. Not everybody should buy right now due to their personal circumstances. But if you're in the cohort of folks who can buy, you can afford to buy at current interest rates, and the Fed has kind of crushed the competition and sent them away, you have an opportunity to buy right now with much, much less competition. And remember that you're not investing in real estate. You're just going neutral, not going long when you purchase your home. You're buying pride of ownership. You're buying stability. You're buying a yard in which to put down literal roots, a neighborhood in which to put down figurative roots. It's a container for your life. So I would really counsel focusing on your long-term goals. Now, because I think it is maybe a more good time than not, on balance time for buyers to buy, does that then mean it's a terrible time to sell? I would say as for buyers, it's not all good or all bad. On the con side, however, you probably as a homeowner thinking about selling have an amazing interest rate locked in. You probably refinanced in the last couple years, and you're going to have to let that go. And that may or may not be financially feasible. It certainly isn't going to feel good. There is reduced demand out there. Jerome Powell has gotten his way and slowed buyers' rolls, and you missed the top of the market. June of 2022 was probably the top of the market. Now, that isn't to say that home values haven't still gone up. In the market I'm in, a median priced home is still up over $100,000 over the last couple years. It's just that you're going to have to share some of that COVID windfall with your buyer if you decide to sell right now in the form of some seller concessions. Now, on the plus side, inventory is still low. And so, there are buyers out there buying homes that are listed, and low inventory should keep prices from falling dramatically. And if you need to sell your home to purchase a new home, you have got a golden opportunity to do so. Contingent offers are being accepted right now. In my long career, there have been infrequent and brief windows when contingent offers have been viable, and this can allow you to make an orderly transition from your current home to a new one without having to take on the risk of purchasing a home before you've sold your old one and owning two homes, or the chaos of selling first and moving twice in between, finding interim housing between houses. So it's a great opportunity to have a smooth transition from one home to another. And finally, I would say, if you're selling and buying in the same market, to an extent, the market doesn't matter. If you sold in 2021 when the market was super hot, whatever you tooketh from your buyer, you probably gaveth to your seller. So the market, is kind of neutral for you. But even in one market, there can be some disparities in demand for certain types of properties. And if you're buying and selling in one market and buying in another city, maybe there are some opportunities for you to look for a place where maybe median price homes are selling really well because there's a big pool of buyers or better. And luxury homes, if you're buying up, are selling at a bit of a discount. So you might be able to take advantage of that. If you want to downsize into a condominium and globetrot, condominiums can be had with the condo market is a little bit weaker right now still, and multifamily properties are selling a little slower as well. Some investors are on the sidelines because interest rates are higher, and they're not buying right now because cash flow is less attractive. So if you're looking to buy a multifamily property or house hack and live in a duplex, I've lived in 2 duplexes myself, it could be a great opportunity for that. Some builders may have more inventory than they would like and might let go of homes with some nice price reductions or concessions. So talk to a savvy real estate broker to uncover those opportunities. And if you have an amazing interest rate locked in and you want to move, maybe think about looking at opportunities to keep your home as a rental and convert that great interest rate that you locked in into a source of cash flow. Go long on real estate and hang on to your home as a rental as you move. For anybody deciding to buy in this market, I would say it's important to just be strategic about how you market your home. Expect to negotiate with your buyer. Be savvy about that and make sure that you maximize the benefit to your buyer for any concessions you give, so that you can minimize the amount that you have to give. And I promised some strategies, and that theme of concessions is actually where I'd like to start. The concessions are things that a seller can give to a buyer to help make their home purchase more attractive or affordable. And buyers and sellers both win when we leverage maximum benefit out of any seller concessions for the buyer. There are six types of concessions I'm going to run through. The first three are pretty self-explanatory, so I won't belabor them. The last three require a little more explanation, and then I'll sort of talk about when you might want to deploy each as we run through them. So one concession a seller can give is obviously to reduce the price. They can also make repairs and fix stuff for you. Pretty self-explanatory. They can also pay a credit for a buyer and offset closing costs that a buyer would otherwise have to pay. Pretty self-explanatory as well. Now, moving on to the things that need a little more explanation, mortgage insurance is something a seller can pay for a buyer. Typically, buyers have to pay for mortgage insurance if they put less than 20% down. You can expect to pay mortgage insurance as part of your monthly payment, and most loans will allow you to cancel that mortgage insurance at a later date when your home value has gone up. But if you prefer, you can rip off the Band-Aid and pay mortgage insurance in a single premium at closing, and this is something you can use seller concessions to cover. Removing the mortgage insurance from your monthly payment lowers your payment and can offset some of the effect of higher interest rates. The last two items I'm going to talk about together because they're both interest rate buy downs that reduce the monthly payment. They essentially involve prepaying interest at closing to lower your mortgage payment. Points, number 5, permanently reduce your interest rate. They are paid at closing to essentially prepay some interest and lower your interest rate for the long term. They're non-refundable, however. So anything you pay for points, any seller concessions you spend on points, even if it's the seller's money, we want to maximize the benefit you get from it. And if you pay points and then interest rates fall and you have the opportunity to refinance and you haven't yet gotten a benefit equal to the cost of the points, then you've left some money on the table in a sense. So remember, you can't get points back. Now, a temporary interest rate buy down works differently. At closing, the seller puts money on account with your lender. Your lender holds this money and then uses it to subsidize your monthly payment for the first 1, 2, or 3 years. The most popular version of the temporary interest rate buy down is called a 2-1 buy down. And with the 2-1 buy down, your payment is based on an interest rate 2% below your real interest rate for the first year, and then 1% below your real interest rate for the second year, and then at your normal interest rate for year 3 and more. And the difference between the discounted payment that you pay over those first 2 years and your real payment comes out of the money that the seller funds at closing. If interest rates fall while you're going through your discounted period of payments and there's still money left in that subsidy fund, that money is credited toward your principal balance. So you're going to get a benefit for sure from temporary interest rate buy down funds in one form or another, either a discounted monthly payment over the schedule for your buy down or a reduction to your principal balance, which essentially helps cover the cost of a potential future refinance. If you think prices are going to fall or stay stable and you don't think you're going to develop a lot of equity in your home and you're not putting 20% down to begin with, then a single mortgage insurance premium can be a really good deal. If you think interest rates are going to stay high, inflation is going to be a continued problem, and you're going to have this loan for a long time, you're not going to have an opportunity to refinance, then a permanent interest rate buy down is a good idea. If you think interest rates are going to fall, then a temporary interest rate buy down is a good idea. It helps you bide your time and enjoy a little lower monthly payment while you're waiting for that opportunity to refinance without the chance of losing any of the money that you've negotiated for the seller to pay. Now, I thought I would show how the kind of a case study, I guess, of how these two types of buy downs might look, just to compare some real world numbers. And to make this as real as possible, I actually used the numbers for a real client who was looking at a $575,000 house last fall. Interest rates were just a little higher, as you'll see, and they negotiated a $15,000 seller concession. So let's look at how we can spend that concession to benefit them. So for starters, just so we have a baseline, here's what their purchase looked like if they paid full price with no concessions. A $575,000 purchase price, they were putting 10% down, and here's their total money to close and their total monthly payment at the interest rates a few months ago. Now, and taxes and insurance rounded slightly are about an additional $600 a month. So just for housekeeping. So what if they reduce the price? Let's take the $15,000 the seller's willing to concede. Let's knock that price down to $560,000. Their mortgage is $504,000. Their money due at closing is slightly lower because they're making a down payment on a little lower purchase price. And their mortgage payment is just a little bit less. They're saving $89 a month, which isn't nothing, but it's not crazy huge savings. So what happens if we pay $15,000 of points to permanently buy a lower interest rate? Well, we leave the price at $575 and we've applied those costs to points. So the money due at closing is just a little lower. The points were slightly less than $15,000, so some of them offset closing costs. We got that interest rate down to 6%, which lowered the mortgage payment by $254. Pretty good. And again, if these folks felt like, gosh, rates are going to stay high, I just want to get the best rate I can right now and call it good, then this could be a really great option. They're going to save $250 a month. But if we think maybe interest rates are going to be getting better and we've got an opportunity to refinance to a lower rate in the future, then a 2-1 buy down can be interesting. And again, the first year, the payment is based on not the 6.75% note rate, but 4.75. And the seller's money is going to subsidize the payment and reduce it $657 a month for the first year. Year 2, the payment is subsidized down to 5.75 effective interest rate, and that reduces the payment by $336. And then year 3 and onward, we're at the full 6.75% note rate, and the payment is exactly the same as it would have been in the initial scenario. And again, if you think the interest rates might be coming down and you're going to have an opportunity to refinance, and critically, you have the ability to afford those stair steps in monthly payment. These folks both worked in jobs that had scheduled pay increases, so they were very comfortable with stair stepping up, and the 2-1 buy down is actually what they elected to do. Now, I do want to take just a kind of a brief detour and assume that they get lucky. And what if interest rates fall in 36 months and they can refinance at 5.5%? Well, they'd be able to lower their monthly payment and lock in permanently $34.73 payment. So they could get themselves to something, between their year 2 and year 1 monthly payments, not all the way down to that year 1 payment. So you can see how carefully deploying a seller credit can really help a buyer navigate the current higher interest rate environment. And this is something as a buyer, you can think about negotiating this with a seller. As a seller, think about offering these things to make a buyer, to help buyers afford purchasing your home. And I do want to can't emphasize enough that I have no crystal ball to know what interest rates are going to be. So this is purely illustrative. I don't want anybody to think I'm promising them a 5.5% interest rate in 36 months. I truly don't know. Last but not least, as far as important strategies in this market, I want to talk about managing volatility. I do think we're going to see interest rates fall this year. That's my prediction, my guess. But, and I do anticipate the volatility, the tug of war that we talked about between the bond market and the Federal Reserve. Things should be trending the right way, but when you go into contract to purchase your home, you've got a deadline by which you have to close, and if interest rates bounce the wrong way, you may not be able to wait until they come back and get back on trend going down again. So you want to manage these risks by locking in your interest rate with your lender. So we want to talk about rate locks as basically an insurance policy, protection from volatility, protection for you as a buyer from volatility. It is possible to lock in an interest rate before you find a home to buy. And this can be a great option if you're either not sleeping at night because interest rates are moving around too much and driving you crazy and stressing you out, or if you're right at the edge of what you can reasonably afford or qualify to buy, then you can protect yourself from losing the opportunity to buy a home by locking in a rate. And then if I'm right about the volatility that we're going to see this year, you can also look for opportunities when the market bounces in a favorable direction and seize the day and lock in an interest rate at that moment. Once you have an interest rate locked in, it is and can be possible to renegotiate or float down to a lower interest rate. Every lender has their own terms for this, and you want to understand what they are as you're locking in your rate, understand what the opportunities might be to take advantage of an improvement and kind of have your cake and eat it too. Have the protection or insurance policy of the interest rate lock, as well as the opportunity to do a little better if the market moves the right way. And if you're looking at building a home or buying a new home, and that could be a place where there are opportunities to get a pretty good deal. Builders are in the business of building homes to sell. And so if they have a little surplus inventory and demand is a little weaker this year, you might be able to get a great deal on a new home. And then during the months that the home is being completed, have the protection and peace of mind of locking in your interest rate. Many lenders offer long rate locks. The company I work for offers rate locks up to 1 year on homes that are being newly constructed. And then last but not least, because real estate transactions can be full of twists and turns and surprises, it is good to understand what the options are for extending your interest rate lock if your initial rate lock wasn't for a long enough period of time. It is typically possible to extend a rate lock. It typically comes at a cost. It is generally less expensive to buy more time at the front end than to pay for an extension later. So managing the timeline for your interest rate lock and understanding extension costs is a good idea. So I hope this was a lot enough. We're going to wrap this up now. I really genuinely hope all of this has given you some insight and some tools to parse the headlines in the year ahead and make some conclusions for yourself and make some decisions about what you want to do in 2023 with regard to your own real estate adventures. I, for one, am rooting for a healthy and balanced market where buyers have choice and sellers and buyers have room to negotiate mutually beneficial terms and make decisions at a pace that's reasonable and sane, and everybody can breathe and make well-informed choices for themselves and their families. We had a wild ride for a couple of years there, and I really feel like 2023 could be a little bit of a breath of fresh air in that regard. It's not to say I'm without some concerns. Lower interest rates are going to be welcome and should bring higher affordability, but as lower interest rates come and affordability improves, that could also bring a little more demand, and too much too fast could heat up the market a little more than we would like. But and for sellers, I do think 2023 will present some challenges, but some opportunities as well, because most sellers, if you're thinking about selling, you're probably thinking about buying too. So all the benefits for buyers are going to accrue to you as well. So time will tell, but I really think 2023 might be a little bit of a sweet spot, kind of a moment when there's a little more balance between buyers and sellers in the market, and kind of a break from a marketplace that has mainly and for too much time been kind of driven by an insufficient supply to meet the demand. So, this should be a year with a little more balance. I appreciate your time so much. Like and subscribe if you found this interesting. I'll make more, probably shorter videos, and I'm happy to share resources, share links to any of the material that I shared in this slideshow. I'll put some of those links in the description, and can't thank you enough for watching. Again, I hope it was helpful. Appreciate you. Have a wonderful year for 2023 in whatever your real estate adventures bring.